Well, the man himself from B. Riley National, Art Hogan, joins me now. Art, it's been a decade, really, since value has challenged growth in any consequential way. We've seen now this year, of course, this rapid rotation into hot sectors, more often than not at the expense of other sectors aren't hot at the time. And investors are sort of batting this whole thing around. And do you think this continues? I mean, do you think this sort of, I guess the reason is there's a lot of cash still uncommitted on the sidelines, but this sort of just seesawing back and forth.
Yeah, I think that, Charles, if I ask you this question, since the March 2020 lows coming into the end of last week, what do you think's outperformed, growth or value? What do you think your answer would be?
I think my answer would be growth by a hair.
Yeah, it's exactly the same. So coming into the end of last week, growth and value from the March 20 lows has been, the performance has been exactly the same. But What's interesting is, look at the first 6 months from March until Labor Day of 2020. Growth far outperformed, right? And it wasn't until after Labor Day, when that growth trade got extended, that people started rotating into that economically sensitive cyclical sector. And that outperformed for 6 months and got back into parallel, right? So, and I think that came with things like reopening news, vaccine news, et cetera. So the drivers in the markets aren't going to go away. We're not going back to a binary world where it's either one or the other. That's why we like to have a balanced approach with growth on one side of that barbell, and you want economically sensitive cyclicals on the other. You can find your favorite themes that have long legs, like 5G, cloud security, cloud computing, edge computing on one side, and on the other side, look at the financials, energy, industrials, and materials. And every 2 months, if you keep that barbell level, it means you're going to be selling winners and buying some of your losers. You're going to outperform this S&P 500 handedly. It did so last year by about 475 basis points. It's outperforming. This strategy is working, but it keeps you diversified, so you're never overexposed to something that's going to come out of favor. And we've seen that happen multiple times since the beginning of this rally back in March.
Yeah, I haven't back tested it. I'm glad you brought it up. It just, if I think though about how this market is, again, this pendulum has gone back and forth. The way you explain it, it's so much more plausible than just sort of the idea of holding, these names and these names, and they offset each other, because it feels like it would also limit your overall, if you want to outperform the market, it could be a detriment. Before I let you go, what's the greatest risk right now for this market, Art?
In my mind, the greatest risk is a resurgence or a slower global recovery, right? So we're recovering faster from the pandemic in the United States. That's not true globally. And if that extends out with some of these Delta variants and we see a slower global recovery, a lot of our recovery won't happen until 2022. I'm not predicting that, but that's probably my biggest concern.
Art Hogan, thank you so much, my